Okay, so the last section of this chapter here, supplemental wage payments, backup withholding, Form W-9, estimated tax payments, and the Form 1040-ES. The 1040-ES is related to the estimated tax payments. So let's start with supplemental wage payments. So this is mostly for like bonuses that are received separate from the regular pay. Could also be well, as it mentions here, so expense allowances that are paid under a non-accountable plan, that's like a reimbursement. When the company does not have an accountable plan is a kind of a contract set up that says that they will reimburse for expenses and they won't be taxable. It's not a big deal to set up. I'm not quite sure why companies wouldn't have an accountable plan in place, but if they don't have an accountable plan in place and employees receive reimbursement for expenses, that's taxable to them. So, but that would be one type. Taxable fringe benefits as well. So, you know, if the employer pays for like a country club membership or something like that, that would be a type of supplemental payment that that would apply here. So all of that stuff could be combined with regular wages, and normally the taxable fringe benefits are going to be combined with regular payments, and they're probably going to be spread out over several pay periods, because if you don't have, we're talking about withholding here, you got nothing to withhold from. You don't have cash to withhold from when it's like a fringe benefit, when it's like a non-cash fringe benefit. So what they'll do is, let's say you get a country club membership, and it's worth $2,400, and you get 24 pays. They'll just add $100 per pay in taxable income. You don't actually get the income because they're giving you the membership instead. So that $100 gets added to the total before any calculation of taxes is done. So that's why it becomes then a taxable benefit. If, however, an employer makes one lump sum payment, they can also, and this is really only going to apply when we're talking about cash, because again, you need some cash to take the withholding from, they can tax it at a flat rate. So if you get a bonus of $1,000 and you're just getting a check for, you know, that bonus is separate, then they'll tax it at that flat rate. The flat rate is 22%. So, and it's also going to be subject to Social Security and Medicare taxes and state income taxes as well. That flat 22% is used unless and I don't know if they mentioned this here, if the bonus is $1 million or more, it's 37%. So, I hope you all get $1 million bonus someday. I hope I do. Probably not going to happen. Not in this job. So, or you can just add the supplemental and the regular wages together and use the method that we used before for calculating what the withholding should be. Let's see. Wages are subject to Social Security, Medicare, and FUTA taxes, as well as state withholding and federal income tax withholding. So here we've got Zofia, base salary of $2,200, paid on the first of the month, single and claims no dependents. She was paid $2,200, and $107.18 is withheld from her earnings. She received a commission in July of $1,000, which is included in her regular wages. In this case, her total wages, her withholding is going to be based on the $2,200 plus the $1,000, so $3,200. So her withholding in this case is going to be $227.18 rather than $100. Now they could, if she gets that commission, she gets it separately. They could get the 22%. They could use the 22% supplemental wage rate or withholding rate on that. So $220 would be withheld separately on that $1,000. Let's see. again, same thing with the bonus there, I think. Flat rate, it would be $220 instead of the other. Questions about the supplemental? All right, so backup withholding. So if somebody refuses to supply their taxpayer identification number, they use employer here. I can't imagine a situation where an employer would ever pay an employee if they didn't have the social security number. I could be wrong. If they're gonna do that, they're not gonna then follow the rules for backup withholding as well. But backup withholding is when, this oftentimes will happen if you have a contractor, you're paying a contractor and they don't fill out a W-9 form. W-9 form provides the company, the payer, with information about their taxpayer ID number, their social security number, and that. If the payee does not fill that out, then what's supposed to happen is the payer is supposed to withhold at 24% backup withholding. Okay. Some payments that are subject to backup withholding: interest, dividends, rents, royalties, commissions, non-employee compensation, and certain other payments made in the course of a trade or business. Also, certain payments made by brokers and barter exchanges, certain payments made by fishing boat operators, okay, are also subject to backup withholding. So you're subject to backup withholding under these circumstances if the taxpayer does not furnish a taxpayer ID number to whoever's requesting it. So if you open up a bank account, and again, I can't imagine how they would ever let you open up a bank account without a taxpayer ID number, but let's just pretend that you do that, and you don't give them a taxpayer ID number, then any interest that they pay you, they're gonna withhold 24% of that and send it off to the IRS. You're gonna get credit for it, right, when you file your tax return, but the idea behind it is, if you don't file a tax return, you never claim this income, you know, you just get lost in the ether. At least they got 24% of your income, right? They got some taxes out of it. It also is used to encourage individuals to supply that taxpayer ID number. So if taxpayer does not furnish a taxpayer ID number, if the IRS has to tell the requester, or if the IRS tells the requester that a taxpayer has furnished an incorrect taxpayer ID number. So you're just going, this would probably be more common with like banks and stuff. You give them the person who opened the account gave them an incorrect taxpayer ID number, and the bank gets notification from the IRS that is the wrong taxpayer ID number. Then now the bank is required to take backup withholding on any payments. IRS informs the payee that they are subject to backup withholding due to non-reporting of any interest and dividends on a tax return. So if you fail to report interest and dividends on a tax return, you got a 1099 for $300 from Capital One, and you didn't put it on your tax return, now you are subject to backup withholding. Now Capital One will be keeping back 24% of any interest that they pay you. So you've got to, that's again, to encourage people to report all of their income. If the payee did not certify to the requester that they were not subject to backup withholding, on the W-9 form, and I think we have an example of a W-9 form here, there's a part down below where it asks you if you're subject to backup withholding. Also, I think certain non-resident aliens, maybe all, are subject to backup withholding as well. So if you didn't answer that question, you are subject to backup withholding. So if you don't answer it no, if you leave it blank or you answer it yes, I am subject, then you're subject to backup withholding. So you can't just not answer it and not be subject to it. Let's see. It does not apply to wages, pensions, annuities, IRAs, Section 404K distributions. I don't know what those are. Oh, from a employee stock ownership plan, health savings accounts, long-term care benefits, and real estate transactions. Specific payees are exempt from backup withholding, as well as specific types of payments. So payees, in order to avoid backup withholding, they have to furnish a correct taxpayer ID number, and they have to fill out this form W-9, and they have to say no, they're not subject to backup withholding. So let's see. They use a W-9 to certify that the taxpayer ID number is correct. That's given is correct. Certify that the taxpayer is not subject to backup withholding or claim an exemption from backup withholding. So let's see, do they give us a W-9? Yes. Okay. And specifically, request for taxpayer identification number and certification. So if you're working for a company that has contractors, you need to have them fill out one of these. And you need to do it before they start work. Because companies can also get into trouble for not having these on file. And it's very common for that to happen. You just pay somebody. You know, hire somebody for contract work and then you just pay them. If you forget to request this and you don't have their taxpayer ID number, or they give you the wrong taxpayer ID number, or they should have been subject to backup withholding, right? This is a CYA, right, for the business. This covers the business for any liability. If they had this filled out, even if it was the wrong taxpayer ID number that was provided, or if the individual said that they weren't subject to backup withholding, but they were, now the responsibility is on the individual, right? But for the business, this covers them, helps to cover them. So the individual is paid out. Indicate what kind of individual they are, or what, if they're a corporation, they can indicate that as well, what their social security or employer identification number is, and then their certification. Under penalty of perjury, I certify that the number shown on this form is correct, and I am not subject to backup withholding because I am exempt from backup withholding, or I have not been notified by the IRS that I am subject to backup withholding, or the IRS has notified me that I am no longer subject to backup withholding, and I am a U.S. citizen or other U.S. person, and the FACTA reporting is correct. Where's the FACTA number here? Exemption for, I don't know what FACTA is off the top of my head. Somebody's willing to look that up, you're welcome to do so. So you gotta certify that that is correct and then sign it and date it. I'm trying to think of let's see. U.S. person is defined below. Where is it defined? Well, it must be a page 2 that they don't have here. So if you are not a U.S. person, you are subject to backup withholding. They just want their money, right? They want a minimum amount of the money, right? And they want to encourage people to provide their taxpayer ID number. Estimated tax payments, I'll come back to that there. So this is, and we've had some problems where we've had estimated tax payments as well. Tax Act assignments, I know we've had Tax Act assignments that have involved estimated payments, and I think some tax return assignments as well. This is where individuals will pay directly to the IRS. Usually it's self-employed individuals or retirees, something where they're gonna owe the tax, but they don't have it withheld. So you are required to make estimated payments in certain circumstances. So if you expect to owe at least $1,000 in tax, and they expect their withholding and credits to be more than, I'm kind of doing this backwards, I'm saying, because they're saying you're, in most cases, if they expect to owe at least $1,000 in tax, and the taxpayer expects their withholding and credits to be less than the smaller of 90% of the tax shown on the current return. So that means that if you owe $10,000, or your total liability is $10,000, but you've paid $8,500. $8,500 is less than 90% of the tax that you owe. Or 100% of the tax shown on the prior year return if the AGI is less than or equal to 150,000, less than or equal to 75,000. 110% of the tax shown on the prior year, the AGI is more than 150,000, or more than married filing separately is more than 75,000. What this means is when you're filing your tax returns, and it turns out that these are like safe harbor amounts that they're talking about. If you paid at least 90% of the tax owed this year, or 100% or 110%, depending upon your AGI, of the tax that was owed last year, then even if you owe $70,000, then you don't have a penalty. So what usually happens is, when you're preparing tax returns, you will look at that information to see if either of these circumstances apply. Then if they're outside of those parameters, then the next year they need to pay estimated taxes. The individual needs to pay estimated taxes to try and avoid that. Now, if it's less than $1,000, you don't have to make estimated tax payments. If that difference is less than $1,000, that's all right. But if it's more than $1,000, then you need to have either paid 90% of the tax shown on the current return, and this is the full tax liability. So this is line, I don't remember which line. It's not the first line because you'd have credits and stuff that bring that down. But at least 90% this year, or 100 or 110% of what you owed last year, in order to avoid any penalties. And you do that by making these estimated payments. So if the taxpayer meets one of the percentage criteria, it is said that they have met the safe harbor. It means you don't have to, you're good. Yeah, you may owe taxes. You're still gonna owe the taxes, but you're not gonna have any penalty, and you don't have to make estimated tax payments. If you don't meet that safe harbor, then you're supposed to make estimated tax payments. They are made on a quarterly basis. Well, no, I shouldn't say that. It's really not quarterly. They're made 4 times a year. First payment is due in April when the tax return is due. This says April 18th because there would have been a weekend and a holiday intervening. So it's the first business day after April 15th. So that's why it's the 18th. Second payment is due 2 months later, June 15th. Third payment is 3 months later, September. Fourth payment is 4 months later, January. So these are always the 15th or the first business day after, and they're always like April, June, September, or January. And taxpayers will use this form 1040-ES. If they're actually mailing it in, this is the form that would be used. Hardly anybody actually mails these in anymore. You can use that EFTPS program that I mentioned, that website by the IRS, to make electronic payments. But if you do use, like, send in a check, my mom, something came up with a check. I think I owed her some money, and I was like, well, I'll have to Venmo it to you. She's like, you can just write me a check. I'm like, no, I don't have checks. No. But you just send in a check, but it has to be accompanied by this 1040-ES, 1040 estimate, and this is all it is. It's just like a quarter of a page form. All it does is say who you are, what your social security number is, how much you're paying, and when you're paying it for. And it says it right on here. So like payment voucher 4, this would be the estimated tax payment that is due by January 15th, so the end of the following year, right? But what you do is you just do the calculation of what the estimated payments should be, and then you divide that by 4. And those 4 equal payments are what are made. Let's see. It's also important, here's one thing that's kind of interesting. So if it's a married couple and one of them is now see, this doesn't really represent, it's usually done for the, when you do it electronically, but I've had issues with this where one of them is self-employed, and so they're the ones that are making the estimated payment. It's for their income. But when they made the estimated payment, they used the other spouse's social security number, like, because they're maybe the primary on there, and so the account didn't get credited properly. to the right spouse. And so you do have to be careful. It was done electronically. So I don't know how they do it here, but maybe you just add both of them. Or you just add your name, yeah. I mean, it doesn't say like primary taxpayer, but you do want to make sure that it's for the correct taxpayer. Let's see. Good on time. Oh, and this is an example then of that. So we got Luis Diaz works as a professor at a local college, also sells real estate as a part-time business. He earned $87,500 from the college, received a W-2, also earned $15,000 in commissions for selling real estate, received a Form 1099 NEC, operates the real estate business as a sole proprietorship, estimates $1,765 more in taxes will be owed for 2023. So a payment will be made for this amount using Form 1040-ES. Assuming the self-employment earnings are consistent throughout the year, estimated tax payments would be made based on the commissions earned each quarter. So $37.50 in commissions were earned each quarter. You'd make $441.25. Send that to the IRS. Now, one interesting thing is you can. So if your income is irregular, so let's say he does real estate, but he only does it in the fourth quarter of the year for some reason or another. So he knows that his income is going to come in the fourth quarter. Well, you don't have to make 4 payments because you haven't received the income yet. You don't have to. You have to annualize it though. You do have to jump through some extra hoops to tell the IRS, hey, I'm going to make one estimated payment at the end of the year because that's when the income actually came in. So, and that minimizes any penalties, and so you don't have, they don't come back after you for like late payments and stuff. So that's called annualizing your income to tell them, you know, I'm matching it up with when I actually received the income. Oh, let's see. Questions?